The goal with business and real estate is the same. You want to keep costs as low as possible, keep cash as high as possible, and not pay any taxes on it. So the IRS will never contact you like by phone or email or anything like that. Anything like that can be a scam. A good rule of thumb is to keep at least 1 month's operating expenses as a cushion set aside.
Good morning, everyone. We are back with Claudio Gil CPA. Claudio, welcome to the show.
Thank you. Good morning.
Good morning. So, Claudio, for those who don't know who you are, can you explain to everybody who you are, what you do?
Yeah. Yep. So CPA is coolest person alive, but in reality, it's certified public accountant. So I'm an accountant. I work with small business owners and real estate investors, and we come together with accounting advisory services, tax preparation, tax planning, payroll, accounting, bookkeeping. I mean, everything that a business owner needs to have the data that they need to be successful.
Gotcha. So when you say that you work with business owners and real estate investors, can you more specify more about who is your ideal client?
Sure. Yeah. So it really can range on the business owner side. For businesses who are just starting out or haven't even formed their business yet, they want to get started on the right foundation, and they usually connect with me. We do free consultations. So it can start as early as that stage in a business relationship. And then it ranges all the way up to my largest clients are doing north of like 8 figures on an annual recurring revenue basis. And we do fractional CFO services. So that's a lot more hands-on and involved. On the real estate side, it's same thing. It's someone who knows that they want to start investing in real estate, whether it's residential, commercial, short-term rental, long-term rental. They want to start growing their investments and their portfolio, while also making sure that they're maximizing their opportunities either on their cash flows or optimizing their taxes. The goal with business and real estate is the same. You want to keep costs as low as possible, keep cash as high as possible, and not pay any taxes on it. So we're able to utilize strategies that we can implement for both types of clients on their tax returns.
We just finished tax season, but what are the top tax advice do you have for business owners?
I would say the biggest ones are, keeping your records together or your documentation. Every time you don't capture a specific deduction, like something that you're already paying for. Home office is a really big one. Utility bills, property tax statements, mortgage interest, if there's a mortgage on the property, already paying for all those things. But if you're not keeping track of it, you're not able to claim the deduction, right? How much did you pay in mortgage interest? How much did you pay in property taxes? All those things we look at so that we can claim it on your taxes. But if you don't have that information, we can't claim it. So people are leaving money on the table when they don't have their records in order.
So let's unpack this a little bit more. A lot of solopreneurs and people who are starting out, even some established companies who have a team of 5 or so, and they're working from home. So how does that apply? Like, what do I need to do in my home office? How does it work?
It's actually really simple. So there's not like an additional, okay, I need to mark this as a home office and make sure that, Claudio knows that this is a home office or whatever the case is. You do have to have a dedicated exclusive space that's used exclusively for business, but it's not anything that you have to declare on a piece of paper or anything like that. You want to gather the square footage of that space that you use for business. So let's say, one business owner uses their garage entirely for business purposes. They don't keep any personal vehicles in there or anything like that, like a mechanic or, someone running an agency out of the garage. Well, that square footage of the garage is calculated against the total square footage of the home. Let's say it's 10% of the total home square footage. And then the way the calculation works is, 10% of the mortgage interest becomes a business deduction. 10% of the property taxes becomes a business deduction. 10% of the utility bills, your electric, your water, your gas, your trash becomes part of the business deductions as well.
Wow. Okay, I'm noticing that. I'm not realizing potentially. Or did we? Last year?
We did, yeah. I don't know if you want to say it in the video, but we definitely, if you remember the form that I sent, saying,
gotcha.
Hey, let me, let's estimate the square footage and everything like that. We did capture that for sure.
All right, sounds good. That's why I have the best CPA on the planet. All right, so continuing with the tax deductions, what are the most tax deductions that small business owners miss?
Well, home office is a really big one.
Gotcha.
Some people don't know if they qualify. if they can claim it or what information they need to provide. Another big one is business use of a personal vehicle. So the distinction here is that everyone knows a business vehicle can be a write-off, right? You see that all over TikTok and social media. But what they don't know is that a personal vehicle, something that's in your personal individual name, can also be used as a write-off up to a certain percentage. So you have to have good records. You want to make sure that you're compliant. That's the most important thing. But if 20% of your use of your personal vehicle is actually for business purposes, for example, I have my personal vehicle. I drive it to clients' offices, to different office visits where I'm meeting clients or where I'm getting meals and everything with clients. Those types of trips are actually business deductions, but not the entire, let's say, purchase price of the vehicle. Because I also use that personal vehicle to go see family and to go see friends and go to a sports game or something like that. So I can't write off maybe all of the value of the vehicle or how much I expend on it for gas, maintenance, car washes, and stuff like that. But I can write off a portion of those expenses. If it's 20% business use, 80% personal use, I'm going to write off 20% of total expenses related to that vehicle. So that's a big one that a lot of business owners miss. One more that I would throw out there would probably just be maybe trying to think of it off the top of my head.
Or I can ask you a follow-up question on the home office.
Please.
So let's say someone have an office. Okay, they have a commercial building and they have a team there and whatever. But they have this hybrid model where they work like 1 day a week or 2 days a week from home. Can they still do that with their home office, or because they have a commercial building now, there's no way?
It gets a little bit more difficult. So this is where you really want to have your records in place and good substantiation of being able to claim the home office deduction. Part of the requirements is that there's no other location where you perform some of the work that you do at your home office. So if, for example, a client maintains a business office and they work from home, like you said, hybrid 2 or 3 days out of the week. Well, if they don't handle any administrative work, no billings, no updating the website or managing reports or anything like that out of the business office, anytime they're in the office, they're only meeting with clients, employees, kind of managing the office, then they can still claim the home office if they're doing the admin and the billing work at home. They're not doing it at the commercial office. Now, how does the IRS know whether, how you're spending your time at each office? That's where you want to have good documentation. And so we have to produce records that show, if it were ever to be examined, that the IRS would reach the same conclusion as us when claiming that deduction.
Like, for example, punch in, punch out from the office building. And
yeah,
would you do the same in your home? Like, oh, I punch in now.
That's one way to do it. That might show more of the time spent at each location, which would definitely help. But then you might want to have, if the punch in shows that you're in the office on Monday, and then your emails show that you're managing billings on Tuesday, sometimes it's not creating a separate document, but it's just having a clear trail in case anything were to be reviewed.
Yes, and this is when the IRS audit come to play. So what triggers an IRS audit?
That's a good question. Yeah. So we never want to, anticipate. We're not saying, oh, okay, this is, we're going to get audited. Let's prepare for that. We want to approach it with a sense of caution, saying if a hostile party were to look at these records, how would they reach the same conclusion as us? Yes or no? Some things that trigger an IRS audit would be inconsistencies year over year. So an important one to keep track of is, if last year maybe the business managed $10,000 in advertising and marketing, and then the next year with the same level of sales, advertising and marketing had jumped up to $40,000 or something like that. Realistically, can the business support that increase in spending year over year with the same amount of sales? On a $100,000 business, probably not, right? 40% of your total revenues coming through to advertising expenses. The IRS might look at that, and it might be legitimate, it might not, but that might raise a red flag in the IRS that triggers a manual review by an IRS agent saying, hey, we don't see a lot of $100,000 businesses spend $40,000 on advertising. Can you tell us more about how you're doing that?
Gotcha.
And then when they look into it, depending on who it is, that might be completely legitimate expenses and you're not going to have any issues. Or it might be that, they're having meals or they're getting groceries and they're calling it advertising expense. And then all of a sudden, it opens up a whole thing with the IRS and disallows that deduction.
Wow. Do you remember last time we had a podcast together, the first one on the Moonshooters?
Yes.
And I told you about this friend of mine who's like, I don't hire an accountant. I don't want anyone to look at my books. And he's so cautious. Well,
Right.
guess what? He's being audited by
Oh, man.
with a $90,000 thing.
Potential outcome. Yeah.
Yes.
Wow.
So it's just so quickly that materialize, like the things that I was afraid of, like for him,
Yeah.
like actually happened.
Wow. Yeah.
Yeah, and now of course he's trying to fix it.
Right.
But just can you imagine the level of stress that a business owner will experience when the IRS send them the. So how does it work? How does the IRS tell you that I'm going to audit you? Is it like a mail or like how does it work?
There's a couple different types of audits. It usually starts, the most common one is they send a letter. So the IRS will never contact you like by phone or email or anything like that. Anything like that can be a scam. So be careful with that as a business owner. They typically start by sending in a letter to the business address on file. They'll say, hey, you've been selected for an audit. I mean, they're very forthcoming. They actually, it's almost like a collaborative type of investigation. But they say, hey, you've been selected for an audit. We want to review, tax year 2022 or whatever the case is. And they say, please provide us with the following list of documents. And they have a document request list. Most audits can be completed via mail, meaning that all you do is you exchange documents via mail. They'll receive it. They'll confirm receipt, send back either additional clarification request, or they'll say, hey, we've concluded our audit. These are the results. It's either, we didn't find anything and everything is good, no changes, or, hey, we're proposing an adjustment based off of what you reported. Your $40,000 advertising expense, we saw that 30,000 of that is groceries, right? So we're only going to let you claim $10,000. And then it'll say, this is the additional tax that might be due. And then you can either accept their outcome or you can appeal their outcome. If you appeal it, that's where that's a whole other stage of like the audit process. But sometimes you may have to visit an IRS agent's office. IRS has offices throughout the nation, and then present your case, to them. And then if they still continue to want to appeal, you can take it to tax court. But at that point, you want to retain a tax attorney. You want to be prepared for a legal battle, and then a judge will decide
Wow.
how that goes. But that's very rare. Most audits will never get past the
Mail exchange.
Right, the mail exchange, yeah. And they're usually concluded in maybe it's a total of about 10 hours of work for the business owner and maybe the accountants just to gather everything. But there's really nothing to fear with an audit too, as long as, you're being compliant and you're being reasonable with your expenses.
Why I have this idea in my mind is that an agent is going to come and look into the books and stuff like that.
That's I think that's very dramatized. Like in movies, one of my favorite scenes is like from Wolf of Wall Street. They're under audit by the FBI or the SEC, and the auditors come to the office location and they start requesting all the records and looking through them right there at the location. And then the Wolf of Wall Street, the cast, they lock them in the office where they have all their documents, and then they crank the heater on. So the agents are uncomfortable, trying to go through the documents, and they're like sweating, and it's so funny to me. But that's very rare. That's sometimes that can happen under criminal proceedings if the IRS suspects that there's criminal intent and they're worried about people destroying documentation or evidence. They may do like a raid. That's beyond the scope of an audit.
Gotcha.
Yeah.
All right. Thank you for that. That was really good.
Mm-hmm.
Okay, so now we are off tax season. So how would a business owner prepare for tax season? And what's your advice on that?
So the best thing you can do, let's say right now, to prepare for tax season. Right now we're about to enter June. Tax season is still more than 6 months away, right? So what can you do to prepare for tax season?
Hire Claudio Gil CPA.
There's
In
definitely
addition to that,
yeah. Besides connecting with an accountant who can help you change the outcome before the year is over, that's one great tip. You can start to review your documentation, almost like prepare for the tax season right now, and just see what information you have, what your spending is looking like, and what other options might be out there for you as you approach tax season. So when I say other options might be out there, what I mean by that is, hey, the business is very profitable this year. Right now, we're about to enter June, where our profits are higher than they were last year at the same time. So, what can we do to invest in the business that would also create deductions to grow the business for the next 12 months or so? A good example is like a business vehicle. If you have profits, if you need help finding more write-offs and your business needs a vehicle, that would be a great time to look at that decision. It's much better to do that now in May, June, July than it is to scramble in December or January or even miss the deduction in that tax year because you waited until January, February to do that. But now the tax year is over.
but a lot of people, mine included, is like we love to have some cash cushion. Like we love to sit on cash for a rainy day. Call me traditional, call me whatever. But the feeling that, everything we make has to be spent does not sit well with me. So how would you balance between these two ideas?
So I do get that a lot. And I love when clients have that kind of attitude about their cash flow because believe it or not, there are a lot of people out there who will spend. Every single dollar that comes into the account, they'll find a way to spend it. Sometimes they're chasing tax deductions. Other times they're taking distributions from the business, and which they're completely entitled to as a business owner. But you have to balance that between sustaining operations versus rewarding yourself for your hard work. What I tell clients in that situation is that don't let the tail wag the dog. Meaning, the dog has to be in control of the tail and wagging it when it's happy. If instead the tail is wagging and then the dog is reacting to it, they're getting pushed and shoved around just by something that doesn't really create much value for the business. So what I mean by that is in the context of a small business and taxes, people here on TikTok go buy a 6,000 pound vehicle, a Mercedes G-Wagon, write it off. It's going to create a deduction in Tesla, whatever it is. And they hear that and they understand it. They know they don't want to pay taxes. So they do everything they can to spend money so that they don't have to pay taxes. But that's really the wrong approach. That's letting the tail wag the dog because you want to have enough cash cushion, one, to sustain operations, but two, in the event of an emergency, if emergency repairs or maintenance, something happens, a vehicle breaks down, something in the home or the office, a pipe burst, something like that. You want to be able to address those issues and balance them against your long-term goals. Really all I can say in situations like that is, what are your long-term goals? And if they haven't thought that far ahead, then that's probably where we should start.
Yeah, there's multiple things to unpack with what you said. One is, okay, is there any ratio? Like, for example, how much cushion should I keep? If you look at Dave Ramsey and his advice, he's like, 3 to 6 months of operation. Mm-hmm. Again, he's more on the personal side of things. Like he's always talking to the everyday employed individual.
Right.
They're saying, okay, emergency fund $1,000, and then 3 to 6 months of your household expenses to keep it in an emergency fund. When it comes to businesses, would these same numbers apply, or like how does it work to keep how much cushion should I keep?
Yeah, that's a great question. So it actually is pretty similar. I'm very big on the belief that an entrepreneur's business is a reflection of them personally and professionally, right? If someone is very disorganized in their personal life, very likely their business is also very disorganized. Or if someone is very disciplined, and then their business is usually very disciplined as well. A good rule of thumb is to keep at least 1 month's operating expenses as a cushion set aside. Eventually, you do want to plan for about 3 to 6 months, and anything more than 6 months can be seen as a little bit overly cautious. And the reason I say that is because businesses will typically have access to other sources of capital than what an individual might have if they got laid off. Meaning, businesses will have access to local or government programs. There's grants, there's local loan programs, whatever the case might be. Lines of credits are typically accessible to a business that has a sustainable, healthy cash flow. So if let's say you did run out of a 6-month emergency fund, well, then the line of credit might be able to sustain you for the next 6 months. And typically, businesses and savvy business owners are agile enough to make changes in their business that will, within 6 months, will start generating results. A great example is the pandemic. So when I was just starting out in my career at a CPA firm, the pandemic hit, and the managing partner, it was a team of about 50 employees. There's like 6 partners, all CPAs or attorneys and qualified professionals. They were very forthcoming with how they were managing the business's cash flow during the pandemic, because a lot of businesses started to freeze their spending, right? They weren't sure if they were going to get sales, depending on their industry. If they're not essential businesses, they could go out of business very quickly. So what our managing partner did was, with the controller that they have hired on staff, they did have a reserve fund. I think it was about it was somewhere between 3 to 6 months. I don't remember the exact number. And then they also started implementing changes to keep as much reserve funds as possible. So they asked certain staff members if they would be willing to cut back on their hours while they navigate the pandemic and see what the situation unfolds. Luckily, they did have 3 to 6 months of reserves, and then there was government programs, PPP, EIDL, which are like grants and funds from the government to help keep those businesses afloat. And typically, again, with a 6-month reserve, you will typically, even if you spend all that, you'll have an opportunity to make changes in your business as long as you're disciplined with reviewing your business's performance.
Gotcha. All right. The other side of this, the other point I want to also make about spending is that when someone has an extra cash in the business, what do we spend on? Because that's another big one. Because if you mentioned like, if you need a company vehicle, then if it's this company vehicle is generating revenue, then yes. Mm-hmm. But should I just splurge on whatever, like when I have extra cash?
It really is a matter of personal preference. At the end of the day, I'm there for the business owner and their goals. And so I'm not, of course, if anything is going way too off the wrong path, I will step in and I'll provide a professional recommendation. But at the end of the day, if the business is healthy, it's got sufficient cash flow, the business owner is happy, they have enough work-life balance, which is very difficult to achieve as a business owner. But let's say, for example, they're very comfortable with how their business is performing and how much time they're spending. Then in that case, if the business has extra cash, it's not a bad idea to issue a distribution to themselves and for them to spend that money however they'd like. It really depends on what that person's goals are and their business goals. If they want to grow rapidly, then definitely invest that back into the business. And it can be anything. It can be vehicle, equipment, staffing.
But that distribution is taxed on the personal side.
It can be. It depends on how the business is structured. But some businesses, like S corporations and LLCs, single member LLCs, they won't pay tax for distributions in majority of cases because the business already gets taxed on its profits. So yes, you can spend that money and create a deduction, but the business is profitable at the end of the day. And so, you pay the tax on the profit and you can distribute as much.
So the distribution comes from the profit bucket?
Yes. Yeah.